the rise in the yields in the long end, I want to explore that further because the implications for other asset classes, what that could mean. Let's just like frame it up and then flesh it out.
Yeah. So very often people, when they think about long end bonds, they don't really realize that long-term interest rates are basically embedded in every asset price that exists. And the reason why that is at some levels relatively simple, I'm sure we all remember our, dividend discount models or our DCFs from when we were first learning how to think about markets and pricing out companies and things like that. And that is that sort of framework is pertinent because what is a company? All a company is a future stream of cash flows that get discounted back to today. And what that means is that long-term interest rates are a critical component of that discounting factor. And so you have circumstances, and we've seen this a couple times in the last 2 years, where once expectations of future growth start to be pretty strong, which they are now, and they were, for instance, last summer, once there's sort of a limit of how strong earnings growth is likely to be or how strong the economy is likely to be. And so once that gets priced in and is reflected in the level of stock prices, then what ends up happening is the long-term interest rate moving around starts to become a bigger driver of what's going on because people are already expecting strong growth. The question is, how much is that strong growth going to be discounted in order to define what the price is of the stocks, for instance? And so the bonds are in the stocks, and the bonds become the big driver of the market. And that's really what we've seen. A big transition has occurred in the asset markets in the last 6 weeks. In the first 3 months of the year, what we saw was stocks and bonds were trading opposite to each other. So stocks were going up and bond yields were rising, meaning bond prices were falling as stock prices were rising. But once expectations of U.S. growth started to reset from pretty weak coming into the year to pretty high by the end of last quarter, what started to happen was that bonds and stocks started to trade in a way that was positively correlated to each other, reflecting the fact that the discount rate is now the primary driver of what's going on in asset returns. And so every day we come in and it's like, what's going on in the stocks? Well, just tell me what's happening in the bond market and I can tell you what's happening with the stocks. And so that's what's going on. The long end is the critical driver of asset prices right now. And I think one of the key risks that exists in the market is that pressure, that continuous pressure on the bond market, on the long end of the bond market, through persistent issuance by the federal government driven by very large deficits. That's creating a risk that the long end of the bond market continues to be pressured higher at a time when, the stock market is very sensitive to how the bond market moves.
Would that be like one of the biggest risks for you today, that dynamic?
Well, I think for equity investors, the biggest risk is that the economy remains too strong, which then creates pressure on the bond market. So in many ways, the expectations that are embedded, say, the stock market isn't the economy, but economists' estimates of or expectations of 2024 growth are now at 2.5%. They came into the year at less than 1%. Now they're at 2.5%. That's very strong. Well, if we have growth at 2.5% and inflation that continues to be elevated, those dynamics combined with a significant supply on the long end coming from the federal government on an ongoing basis, that's going to probably pressure bond yields higher. And so that's on net bad for stocks, not good for stocks, because the long end of the bond curve is just so critical to pricing the equity market at this point.
Yeah. Okay. So when you look at like